Good afternoon, ladies and gentlemen. It gives me great pleasure to give you an update on Neometals. In summary, this just basically says speak to a licensed investment advisor. So who are Neometals today? We've got two main commodity focuses, lithium and titanium vanadium deposit. Our lithium deposit is Mount Marion. It's the world's second largest source of hard rock lithium production. We developed that with a couple of multi-billion-dollar companies in 2015, constructed in 2016, in operation from early 17, and operating at steady state now. That's the backbone of the lithium business. We're now in the final stages of evaluating putting a lithium refinery in town, basically to take our share of offtake from 2020, 2021, and to process that into lithium hydroxide that'll essentially go into the battery supply chain. The third plank in the lithium business is a lithium recycling. This is essentially cashing the lithium at the end of life. The main economic driver behind that is to pull down our costs. For every tonne of lithium hydroxide we recover in the recycling, we'll recover a tonne of nickel metal and 140 kilos or so of cobalt. Also, we have a titanium vanadium deposit, Barrambie. We'll get into that. It's been a bit of a focus the last couple of days. We've recently announced we're going to update a feasibility study that we did in 2009 on Barrambie. It is the world's most advanced undeveloped vanadium deposit. In terms of a company snapshot, we're pretty well funded. We've got about $40 million in cash and investments. The board and management are the largest shareholders in the company. However, for most lithium companies this year, it's been a bit of an annus horribilis with the Chinese commodity prices for lithium halving. It's basically dragged down every lithium producer and developer in the world, notwithstanding that we made record profit this year. So we're a bit different to most mining companies. We approach mining in a different sort of way. What we try to do is understand where in the value chain the money is made, and to basically bring in big partners. We take the risk, or we add value first with the drill bit evaluations, getting the permitting done, making the pie bigger, and then bringing in a couple of big multi-billion-dollar companies to turn these into cash, not to put a lot of capital into the mine to start off with. That's worked pretty well for us. Case in point with the lithium, we invested about $3 million. So far we've pulled out $100 million in selling equity and dividends from the mine, and we'll apply the same rigour to our titanium vanadium project. We've returned about $34 million back to our shareholders through dividends and on-market buybacks in the last couple of years. So first, if we have a look at the integrated lithium business, we'll run through that. Mount Marion is the cornerstone. It's making lithium concentrates that we're currently exporting up to our off-taker and fellow shareholder, which is Ganfeng Lithium, China's largest lithium producer. It's fair to say that the main focus for us there is it's a secure source of feedstock and it's an annuity cash flow for us. What we're really wanting to do is invest in the lithium hydroxide, the chemical section. The IRRs are twice of what the mine is. The lithium recycling's even more profitable. So we'll have a bit of a fly through, or you can turn the sound off. That's right, thanks. So that's what the world's largest greenfields lithium concentrator looks like. Processes about 2.4 million tonnes through that per annum. We've got a remaining resource of about 70, just a bit under 72 million tonnes of resource. We produced about 428,000 tonnes of concentrate, second only to Greenbushes last year. That might change next year with a few mines coming on. We might drop back to probably third. So essentially, what we do is we mine the white rocks, take them over there, make them smaller, and then export them up to China. How we approached this was, we owned 100% of the business, but we weren't too keen on putting a couple of $100 million into a commodity that we hadn't operated in before. So what we did is we bought Australia's largest contract processor of minerals, a company called Mineral Resources. They've essentially invested $300 million in the plant. We gave them 30% equity for doing that, and we sold China's largest lithium producer, Ganfeng, equity in a couple of tranches at higher prices for a take-or-pay offtake agreement, life of mine, and we have clawback rights from 2020. So the next focus is to actually turn it into lithium hydroxide. So the mine, it's very long life, it's operating at steady state, and it's very profitable. So for us, half of the value is in the cash flow stream. The other half is it provides a secure feedstock for producing lithium hydroxide. And that's the main reason why the Chinese lithium guys came down to Australia and paid so much money for it. So there we've got the plant. That's the finished product there. So basically what we'll do is those trucks will leave Mount Marion. Instead of turning left to going to Perth, they'll turn right and head back towards Kalgoorlie, where we're looking to put the Kalgoorlie lithium refinery. Essentially, we've got a 100-acre site there. Fantastic infrastructure. We've got National Railway, National Roads, next door to the Water Corporation. We've got high voltage power, gas to site. It is really a dream location. In terms of the timeline, we've nearly finished the feed study. That'll be this month. The results will be out in the March quarter, feasibility in the June quarter, and we'll get to an FID about mid next year. The last bit there is the battery recycling. So this one's not starting up. That was going to be the shredder that I was going to show you. But look, anyway, we will have some information into the market about that soon in terms of running the pilot plant up in Canada. But for us, the titanium vanadium has been particularly relevant the last couple of days. What we've done is we've announced that we're updating the definitive feasibility study. Barrambie is one of the world's largest vanadium deposits. It's the world's second highest grade hard rock deposit. We own 100% of it. It's on granted mining leases, no native title issues. We've got full environmental approvals to build the mine and to build the chemical plant. The main granted mining lease contains the ore body. It's 11 kilometres long. We've done 1,000 RC and diamond holes down to a set depth of 80 metres. It is truly one of the world's largest resources. I think we're at 280 million tonnes of resource. Contained within that, we have a higher grade eastern band, higher titanium on the right hand side, and then the central bands, which are the vanadium. So when you extract them, you actually extract both of them twice. So one, we're looking at building a vanadium operation, but we're going to mine this high titanium ore at the same time. And so what we're trying to do is to realise money from that. How we're doing that is to, one, investigate a dual stream of test work. So one, the original feasibility study took the vanadium ores into a concentrate at 1.4 into vanadium pentoxide and then ferrovanadium. That's what we're updating. What we started last year was we took a bulk sample out of the high titanium ore. We're making concentrates up in China at IMUMR, which is a government-owned laboratory in Sichuan. We're making chloride-grade titanium slag that'll go into the Chinese pigment market. In terms of comparison, Barrambie is second only in sort of head grade to Largo's Maracas deposit. Then you've got Bushveld there down at about 0.57 or so. Barrambie sitting at sort of 0.82. So the study will look at mining, crushing, making a magnetic concentrate, and then the refinery section. It'll be reported in stages so we can have a look at the direct ship or selling a concentrate or the full integrated operation. The historical feasibility study results, produced about 6,160 tonnes of vanadium at less than $20 a kilo. And that is down in the bottom quartile of costs. The direct construction costs, they're the same if you were going to build them in South Africa or Australia. They are what they are. The mine life at 12 years, that was from when we used a price of $30 a kilo. It's now between $120 and $140. So it'll be a long-term competitive operation, sitting down there at the bottom end of the cost curve. The current prices are fantastic. Look, they'll come back into a normal range, but what is the new normal? You need 3 or 4 new primary mines to do that. And look, unparalleled upside. We've drilled it down to 350 metres and the government seismic shows it goes down 4 kilometres. And I'll leave you with the milestones. So thank you very much.